I've spent decades investing in businesses, markets, people, and deals that either make money or destroy it. And if there's one thing I've learned, it's this. Most people don't lose financially because they're unlucky. They lose because they make emotional decisions at the worst possible time. Buying a house in 2026 for most people is shaping up to be exactly that kind of emotional decision. Let me be very clear. I am not against homeownership. I own real estate. I invest in it. I understand its value, but I also understand timing, risk, and opportunity cost. And right now, the numbers do not support the idea that buying a house in 2026 is a smart financial move for the average buyer. Look at what has happened over the last few years. From 2019 to 2024, housing prices exploded. In many markets, prices jumped 50, 60, even 100%. At the same time, incomes did not. Most wages rose maybe 15 or 20%. That gap is the danger zone. When asset prices rise far faster than income, affordability collapses. And when affordability collapses, buyers start making compromises that hurt them for decades. Now add interest rates to the equation. For years, money was cheap. 3% mortgages were common. That era is over. Even if rates begin to fall slightly, we are not going back to ultra-cheap borrowing. On a $400,000 mortgage, the difference between 3% and 6.5% is not small. It's more than $500 a month. Over the life of the loan, that's well over $180,000 in extra interest. That is real money. That is opportunity lost. Here's what worries me most. People are buying out of fear. Fear of being priced out forever, fear of missing the next surge, fear of watching others build equity while they throw money away on rent. Fear is poison in investing. Fear makes you stretch your budget. Fear makes you ignore risk. Fear makes you believe stories instead of numbers. And the story people are being sold is simple. Prices always go up. Real estate is safe. You can't lose. I've been in markets long enough to tell you that is not true. Japan's housing market peaked in 1991 and took decades to recover. The U.S. housing market collapsed in 2008. In many cities, prices dropped 30 to 50%. People were stuck in homes worth less than their mortgages for years. They didn't lose everything, but they lost time, flexibility, and options. Now let's talk about 2026 specifically. Central banks are still fighting inflation. Governments are drowning in debt. Cutting rates too fast risks another inflation surge. That means borrowing costs are likely to stay higher than what buyers have grown accustomed to. At the same time, households are under pressure. Food, energy, education, and healthcare costs are all up. That limits how much people can realistically pay for housing. At the same time, supply is finally responding. Builders are increasing construction. Institutional investors who bought massive numbers of homes during the low-rate years are slowing down or selling. Cities are tightening rules on short-term rentals. More supply plus constrained demand does not create a boom. It creates a slower market. I've seen this cycle before. When everyone believes prices can only go up, that's when risk is highest. You don't need a crash for a bad investment. You just need prices to stagnate while your costs stay high. If you buy in 2026 at peak prices with expensive debt and values go sideways for 5 or 10 years, your capital is trapped. You are working for the house instead of the house working for you. And that brings me to opportunity cost. Every dollar you put into a down payment is a dollar you cannot invest elsewhere. Historically, diversified stock markets have returned around 10% a year before inflation. Real estate in many markets barely keeps up with inflation once you account for taxes, insurance, maintenance, and transaction costs. When you concentrate your net worth into one illiquid asset, you are making a massive bet on a single outcome. I don't invest on hope. I invest on numbers. And in 2026, the numbers are telling me to be cautious. Let me talk about what ownership really costs because most people only look at the mortgage payment. That is a mistake. Ownership is not just principal and interest. It's property taxes that rise as governments look for revenue. It's insurance premiums that have jumped dramatically due to climate risk. It's maintenance that averages 1 to 3% of the property value every year. On a $500,000 home, that can mean $5,000 to $15,000 annually just to keep the asset functional. Roofs fail, furnaces die, plumbing leaks. These are not rare events over a decade. They are guaranteed expenses. When I evaluate any investment, I look at cash flow. If an asset consumes cash instead of generating it, I ask a hard question. What is the return, and is it worth the risk? In many markets today, owning costs far more per month than renting the same property. I've run the numbers. In some cities, a two-bedroom rental might cost $2,000 a month. Buying that same unit with 20% down at current rates could cost nearly $3,000 once you factor in taxes, insurance, and maintenance. That $1,000 difference is not trivial. Invested monthly over 10 years at a reasonable return, that gap alone can grow into six figures. People tell me, but I'm building equity. Yes, some of your payment goes toward principal, but in the early years of a mortgage, the majority goes to interest. You are paying the bank first. Equity builds slowly at the beginning. Meanwhile, your cash is locked into a property that cannot be easily sold without cost. Liquidity matters. In my world, flexibility is everything. A house is illiquid. If you need to move for work, family, or opportunity, selling takes time and money. In a slow market, you may have to cut the price or carry two homes. Compare that to a liquid portfolio that can be adjusted in minutes. And then there is leverage. A mortgage is leverage. Leverage amplifies gains in a rising market. It also amplifies pain when costs rise or values stall. I've watched people stretch to qualify for homes because they believe appreciation will save them. Then rates reset, or taxes rise, or income drops. Suddenly, the house becomes a financial burden instead of an asset. I once met a couple who bought at the top of their budget in a hot market. 2 years later, their adjustable rate reset and their payment jumped by $600 a month. They didn't lose the house, but they lost savings, travel, and peace of mind. They were working for the mortgage. Let me be blunt. A home is primarily a lifestyle choice. It becomes a financial asset only if the numbers make sense. In 2026, in many markets, they don't. Now let's address the emotional argument. Renting is throwing money away. No, it isn't. Housing is a consumption expense. Whether you rent or own, you pay for shelter. The difference is how much capital you tie up and what return you get on it. If you can rent for significantly less than the cost of owning and invest the difference, you may end up wealthier without the stress and risk of ownership. I also hear, but real estate is a hedge against inflation. In theory, a fixed-rate mortgage locks in payments. In reality, when you buy at inflated prices with high rates, you are paying a premium for that hedge. If inflation falls and wages don't surge, your real burden remains heavy. Let's talk about concentration risk. When someone buys a home, especially early in life, that single asset often represents the majority of their net worth. That violates a basic principle of investing: diversification. You would never put all your money into one stock. Yet people do it with property every day. If you want exposure to real estate, there are alternatives. Publicly traded real estate investment trusts provide diversification across sectors like logistics, data centers, healthcare, and residential. They generate income. They are liquid. They do not require you to fix a roof at midnight. Here's my practical test. If the total cost of owning is more than 20% higher than renting, think twice. If you cannot put down 20% without draining your emergency fund, think twice. If your mortgage payment exceeds 35% of your gross income, you are one setback away from trouble. I am not predicting a collapse. I am pointing out asymmetry. The upside of buying in 2026 may be modest. The downside is years of high payments, limited flexibility, and the risk of stagnating prices. When the risk is high and the reward is uncertain, smart investors step back. I've seen this cycle before. When everyone believes prices can only go up, that's when risk is highest. You don't need a crash for a bad investment. You just need prices to stagnate while your costs stay high. If you buy in 2026 at peak prices with expensive debt and values go sideways for 5 or 10 years, your capital is trapped. You are working for the house instead of the house working for you. And that brings me to opportunity cost. Every dollar you put into a down payment is a dollar you cannot invest elsewhere. Historically, diversified stock markets have returned around 10% a year before inflation. Real estate in many markets barely keeps up with inflation once you account for taxes, insurance, maintenance, and transaction costs. When you concentrate your net worth into one illiquid asset, you are making a massive bet on a single outcome. I don't invest on hope, I invest on numbers. And in 2026, the numbers are telling me to be cautious. Now let's talk about psychology, because this market is being driven as much by emotion as by fundamentals. Real estate is marketed with dreams, stability, security, success. Open houses are staged to trigger desire. Headlines celebrate rising prices as proof that buying is always right. That environment makes it hard to think clearly. Markets don't care about emotion. They respond to supply, demand, and the cost of capital. One of the biggest mistakes I see is people relying on national averages. Real estate is local. Some regions tied to growing industries will remain strong. Others will stagnate or decline. Even within the same city, one neighborhood can thrive while another struggles. Buying based on a headline instead of local data is financial negligence. Then there is climate risk. Insurance costs are exploding in areas prone to floods, fires, and storms. In some regions, insurers are pulling out altogether. A home that seems affordable today can become extremely expensive to insure or even uninsurable. That risk is rarely factored into purchase decisions, but it directly affects long-term value. Policy risk matters too. Governments are under pressure to address housing affordability. Vacancy taxes, stricter rental rules, higher property taxes, zoning changes. These policies can change demand overnight. I've seen markets soften simply because regulations made real estate less attractive to investors. Let me give you a real example. In one city, new regulations targeted short-term rentals and vacant properties. Investor demand dropped, listings increased, prices declined about 8% over 18 months, no crash, no headlines. But for buyers who purchased at the peak, their equity disappeared on paper. Those who waited had better choices and stronger negotiating power. People tell me you can't time the market. That's true. You cannot pick exact tops and bottoms, but you can assess risk. When prices are stretched and financing is expensive, the margin for error is small. Waiting for better conditions is not speculation. It is risk management. I also look at demographics. Aging populations, slower growth, remote work. Demand patterns are changing. Large suburban homes may not be as desirable in 20 years as smaller, efficient, well-located properties. Buying without considering long-term demand is short-sighted. Before anyone buys, I ask them one question. What is the goal? If the goal is stability in one location for decades and the budget supports it comfortably, ownership can make sense even in a tough market. If the goal is wealth creation and flexibility, locking into an expensive, illiquid asset may be the wrong move. Financial independence is built by controlling expenses, saving consistently, and investing in productive assets. A primary residence does not produce cash flow. It consumes it. It may appreciate, but after inflation and costs, the real return is often lower than people assume. Here is a framework I use. Look at the price-to-income ratio in your area. Historically, above 5-to-1 signals expensive markets. Look at rental yield. If rents are low relative to prices, returns are weak. Look at interest rates relative to long-term averages. In 2026, many markets fail all three tests. Run scenarios. What if rates stay high for 5 years? What if property taxes rise 10%? What if you need to move in 3 years? If the deal breaks under these scenarios, it is too fragile. I am not saying nobody should buy. I am saying the blanket advice that buying is always smart is wrong. That advice benefits sellers, lenders, and agents. It does not always benefit buyers. Wealth is built by owning assets that grow faster than inflation or generate income. In 2026, for many people, a primary residence does neither effectively. Patience is not inaction. It is preparation. I've seen this cycle before. When everyone believes prices can only go up, that's when risk is highest. You don't need a crash for a bad investment. You just need prices to stagnate while your costs stay high. If you buy in 2026 at peak prices with expensive debt and values go sideways for 5 or 10 years, your capital is trapped. You are working for the house instead of the house working for you. And that brings me to opportunity cost. Every dollar you put into a down payment is a dollar you cannot invest elsewhere. Historically, diversified stock markets have returned around 10% a year before inflation. Real estate in many markets barely keeps up with inflation once you account for taxes, insurance, maintenance, and transaction costs. When you concentrate your net worth into one illiquid asset, you are making a massive bet on a single outcome. I don't invest on hope. I invest on numbers. And in 2026, the numbers are telling me to be cautious.